name is Patrick Soulier from the Edmonton chapter of Advocates. I'd like to welcome all the Advocates members and their guests and the Canadian public from across the Western provinces. From Manitoba to British Columbia, this presentation by the Deputy Governor of the Bank of Canada, Mr. Tim Lane. To do the formal introduction, I would like to introduce Julie Martini, Vice President, Public Affairs and Marketing for Advocates, the Financial Advisors Association of Canada. Julie, please take it away.
Thank you, Pat, and good morning, everyone. Before I introduce our distinguished guest, Advocates in the Bank of Canada would like to acknowledge that we are meeting on the land of the First Nations, Inuit, and Métis. We pay our respect to Indigenous peoples across the country and to their ancestors for their immeasurable contributions to this country. It is now my pleasure to introduce our speaker for today's event, Tim Lane, Deputy Governor of the Bank of Canada. Mr. Lane became Deputy Governor in 2009. In this capacity, he shares responsibility for decisions with respect to monetary policy and financial stability. He also oversees the bank's funds management and currency functions, including the bank's ongoing research and analysis of developments in financial technology, crypto assets, and digital currencies. Mr. Lane served for 20 years on the staff of the International Monetary Fund. During that period, he contributed to the IMF's analysis of numerous countries and conducted research on a wide range of topics, including monetary policy, financial crises, IMF reform, and economic transition. In 2008, he joined the Bank of Canada as an advisor to the governor, a position he held until his current appointment. Born in Ottawa, Mr. Lane holds an honors BA from Carleton University and a PhD in economics from Western University. Mr. Lane, on behalf of Advocates, welcome.
Well, thank you very much, Julie, for that introduction. And thank you to Advocates for hosting this event. I mean, certainly we're getting used to these virtual events now, but I really look forward to the time when I can get on a plane and come and talk to you in person. I always enjoyed my trips to Western Canada, and I can't wait for them to be possible again. So, I guess a starting point is, this has been just an extraordinary 15 months we've been through. And the COVID-19 epidemic remains first and foremost a public health emergency that continues to cause widespread suffering and disruption in Canada and around the world. The economic consequences have also been massive, with job losses that exceed those of any recession in Canadian history, both in their number and in their sheer suddenness. As vaccination rollouts speed up and cases trend down, we can start to imagine better times, but we're still a long way from a complete recovery. Too many people remain out of work, particularly in the sectors hit hardest by lockdowns and physical distancing measures. These have been tough times for many. Yet on the whole, the Canadian economy has come through better than expected. One important reason is the large-scale government support that boosted household disposable incomes and kept many companies afloat. At the Bank of Canada, we also did our part by helping to keep credit available and its cost low. Throughout this period, the resilience of Canadian households and businesses has also been striking. This resilience has been enabled in part by the digital technologies that have become more widespread, giving us new ways to shop, serve customers, and work remotely. The pandemic has not only accelerated the digital transformation that was already underway in Canada and globally. My remarks today will offer a progress report on the economic recovery in Canada, putting some context around the interest rate decision that we announced yesterday. I'm also going to make some observations about the digital transformation and what it means for where the economy is heading beyond the pandemic. We've spent the last year climbing out of a very deep hole. During the worst of the pandemic, the Canadian economy contracted by almost 15% and lost about 3 million jobs. Economic activity and employment both rebounded strongly last summer, but the second and third waves of the virus each brought setbacks, so real activity and employment are still below pre-pandemic levels. By April of this year, when the bank published its latest monetary policy report, or MPR, there was reason to be more confident in the Canadian economy's resilience. Despite renewed lockdowns, we were seeing signs of strong growth in the first quarter. Households and businesses had clearly adapted better than expected. Job losses were mostly in sectors where activities are hard to physically distance. Canada's export markets were improving too, led by the United States, thanks to its rapid vaccination rollout and substantial fiscal stimulus. Then, the third wave of COVID-19 dealt Canada another blow this spring. More contagious variants were spreading around the world and across the country, adding new uncertainty and straining hospitals in some areas. This slowed many people's return to work, particularly in contact-intensive sectors, and led to further job losses. But with Canada's vaccinations now in high gear and lockdown measures helping to contain the virus, this setback should be temporary. The economic data that have come in over the past few weeks provides signs of increasing resilience that bode well for the underlying recovery. One key piece of information that arrived last week was the national accounts data. These show that real GDP in Canada grew by about an annualized 5.5% in the first quarter, bringing the level of GDP to only 1.75% where it was below the pandemic, and that's in contrast to the 15 that I mentioned earlier. The first quarter result was a bit lower than the 7% that we projected, but the data are quite encouraging. Household spending was even stronger than expected. GDP growth wasn't as high as in our projection, but that was mainly because businesses were drawing down their inventories and increased imports more than anticipated. Overall, the data provide indications of rising confidence and resilient demand. They confirm that the Canadian economy is heading for a strong first half of 2021, despite the most recent lockdowns. We still expect positive growth in the current quarter, close to the 3.5% we were projecting in April. That being said, the latest labor force survey released on Friday shows that there were 275,000 net job losses over April and May during the renewed lockdowns, and that the unemployment rate is still above 8%. I'd like to mention a few key elements of the economic picture. One is housing, which has provided a strong boost for the economy during the recovery. Signs of moderation have appeared in recent weeks, but the level of activity remains very high. The housing boom has been driven by both a desire for more living space and by low mortgage rates. And the desire for more space, in turn, has been driven partly by the fact that digital technology has made remote work seem like a viable option for many people, even after the pandemic is over. But as we've noted, there are also signs that extrapolative expectations, the fear of missing out, are taking hold in some markets. So we are watching this closely. Another important factor has been the strong gains in world prices for oil and other commodities. This mainly reflects the brightening prospects for the global economy, and it is good news, especially for Western Canada and other oil-producing regions. It offers some relief from last year's commodity price collapse, which came after 5 years of painful adjustment to the earlier plunge in oil prices. Inflation, meanwhile, is a more complicated story than usual. Many prices plummeted at the onset of the pandemic, and inflation was running well below our 2% target until quite recently. In April, though, consumer price inflation increased to about 3.5%. This was largely in line with what we projected in our April monetary policy report. It reflects the fact that year-over-year inflation is comparing today's prices for a range of goods and services with last year's rock-bottom prices, so-called base year effects. It also reflects higher gasoline prices and other temporary factors. We expect inflation to stay around 3% through the summer and then to ease later in the year as remaining slack in the economy pushes inflation down. As we said in April, there is unusually high uncertainty about how much policy support will be needed and for how long. That's partly because of the uneven economic effects of the pandemic. It's also, though, because the pandemic may be accelerating structural changes in the economy, making it hard to gauge the economy's potential to grow without creating inflation. Here, a key element is the adoption of digital technologies. So let me spend a few minutes now discussing that. Now, anyone with a smartphone knows that digitalization was well underway before the pandemic. Investment in information and digital technologies has been solid around the world, including in Canada, for several years now. We can see this transformation most directly in the growth of the tech industries. Computer design and related services, which is a proxy for the digital sector in Canada, started growing almost 3 times faster than the overall economy in 2013. By 2019, economic activity in that digital sector made up almost the same share of Canada's economy as mining, oil, and gas combined. But the impact of the transformation extends well beyond the tech industries. All kinds of service providers, from banks and insurers to telecommunications firms and governments, have harnessed digital technology to improve their operations and interact with their clients. Retailers have expanded online platforms and made them increasingly user-friendly. Digital technologies are also transforming the goods-producing and commodities sectors. Auto manufacturers have used increasingly sophisticated robots for decades, and in more recent years, other industries have been following their lead. And the energy sector uses automation, artificial intelligence, and machine learning to cut costs and emissions, and to make work sites safer. Through the COVID-19 recession, digital technologies have played a central role in safely sustaining economic activity. One obvious example is video conferencing technology, such as what we're using today, which has allowed millions of Canadians to do their jobs from home. And then there are the apps that allow people to order from restaurants and shop with limited physical contact. The need to quickly adopt and even develop technologies during the pandemic has given the digital sector added momentum. While the Canadian economy as a whole shrank by about 5% in 2020, the digital sector grew by about 3.5% and continued to accelerate into 2021. This has helped support employment through the pandemic. Technology-driven adaptation has also changed the types of jobs that are available. There have been fewer openings for servers in restaurants, but more for delivery drivers, and fewer for in-store retail sales clerks, but more for people in warehouses fulfilling online orders. We've also seen ever-expanding opportunities for people with digital skills, skills that were already in high demand before the pandemic. For instance, there have been fewer openings for events planners, but more for people to manage social media communities. And as workplaces have adapted to virtual operations and remote work, companies of all kinds have sought people to produce and support their digital infrastructures. These developments show that the digital transformation has been accelerated by the pandemic, and they suggest that it could continue to accelerate beyond the current recovery. Growing evidence that the pandemic has pushed firms in all sectors to overhaul their business models more aggressively than planned. Roughly half of the Canadian executives who responded to our Spring Business Outlook survey said that it has sped up their adoption of digital technologies. Still, it's going to be challenging to capitalize on the opportunities that this transformation presents. Businesses are already having trouble finding people with the right skills, and these skill shortages could intensify in the coming years. Moreover, the opportunities could be distributed unevenly. Some people could even see fewer opportunities, at least at first, as some businesses use technology to replace workers or struggle to remain viable. Many of the jobs that could be displaced are also those that have been hit hardest by the pandemic. Jobs that are disproportionately held by women, young people, low-wage earners, and racialized Canadians. This all underscores the importance of working to equip all Canadians to take advantage of the expanding digital opportunities. This is a key policy challenge. Education, job training, and labor market policies are essential to prepare Canadian students for the digital economy and to enable workers to transition to the jobs of the future. Governments, academic institutions, and businesses all have roles to play here. Now, let me bring this back to the Bank of Canada's responsibilities. We make monetary policy decisions to achieve our 2% inflation target on a sustainable basis by supporting the economic growth required to get there. And we have been very successful. Inflation has averaged just under 2% over 3 decades. A key question in this context is, once the pandemic is behind us, what does the digital transformation mean for the Canadian economy's potential output? That is, for how much the economy will be able to grow without sparking inflation. Most severe recessions have a prolonged negative effect on potential for 2 reasons. First, the widespread economic disruptions of a recession tends to cause some firms to delay or cancel investments and others to shut their doors. That reduces the economy's capacity to produce, which limits its growth. Second, when people face a long spell of unemployment, their skills tend to get rusty and they lose touch with the job market, making it harder for them to get back to work. This is known as scarring. It reduces the economy's workforce and its overall productivity. There is no doubt that the recession caused by the pandemic, like all recessions, will result in lost capacity and scarring. But the accelerated digital transformation has supported resilience so much that we now think the damage to potential will be less than we earlier feared. In our latest monetary policy report, we updated our estimates of potential output as we do every April. Based on the resilience that we've seen over the past year, we estimated that the effects of the pandemic had lowered potential less than we had thought they would. We also estimated that the accelerated adoption of digital technology would boost productivity growth. We took a cautious view, though, because the size and timing of this boost are both highly uncertain. But there is a good chance that productivity growth, a key driver of potential, will be stronger than expected, giving the economy more room to grow before inflation becomes a worry. I should stress that there is always a lot of uncertainty around our estimate of potential output, and this is particularly true these days. We've never seen a recession or recovery quite like this one, with such widely different effects across sectors, businesses, and groups of workers. Also, the restrictions have affected both demand and supply. That makes it harder to interpret economic signals. As well, the digital transformation itself is a source of uncertainty. First, because it's difficult to predict the future benefits of innovation. And second, because these benefits can be very hard to detect and measure while they're coming about. In fact, it's possible that much of the investment that enhances productivity isn't even showing up in the statistics. That's because cloud services or databases are less tangible and therefore harder to measure than, say, buying and installing a new line of factory machinery. Measuring intangible investments that travel across borders is particularly difficult. Given the unusually high uncertainty around potential and its future growth, we'll need to rely on a wider range of information than usual to assess how much slack exists in the economy. That assessment is key to deciding when to start scaling back our monetary policy stimulus. As we said in April, this will include looking at a range of indicators of labor market conditions. We will have more to say about that in our next MPR in July. The main message I want to leave you with is this: the digital transformation has not only been very helpful during the pandemic, but it also stands to increase our productivity and, in turn, our growth potential for years to come. But we have to be mindful of the challenges associated with this transformation and do all that we can to put people and businesses in the best position to benefit. Now, for the benefit of our wider web audience, I'm going to repeat this last few words and a few others later in French. Le message à retenir, c'est que la transformation numérique a été très utile pendant la pandémie. Elle devrait aussi augmenter la productivité et donc le potentiel de croissance de notre économie à l'avenir. Mais cette transformation pose des défis et il faut tout faire pour que les gens et les entreprises puissent en profiter pleinement. Now, let me turn to the discussions around our policy decision yesterday. Earlier, I talked about how the economy and inflation have evolved compared with our April projections. Now I'd like to explain what it all means for our policy decision yesterday and tell you about some of the key issues preoccupying me and the other members of the Bank of Canada's Governing Council, which has the responsibility of making these decisions. The bottom line is that the Canadian economy has been largely on track with our story. We haven't seen much over the past 6 weeks that would materially change our view of the outlook. Recent data, as I discussed a little earlier, have confirmed that growth in the first quarter was largely in line with our estimates and that shutdowns associated with the third wave of the virus are having an impact on the economy in the second quarter. Unfortunately, this is once again affecting jobs in contact-sensitive sectors, the same jobs and the same people who've been most affected by previous shutdowns. The employment rate remains well below its pre-pandemic level, with women, young people, low-wage earners, and racialized Canadians continuing to bear the brunt of job losses. The good news, though, is that vaccinations are rolling out at or faster than the pace we assumed in April. We've also seen other economies, such as the United States, pick up smartly as they have reopened. These developments are encouraging and suggest that we are on track for a strong consumer-led recovery as containment measures ease here in Canada. Et en français, mais il y a de bonnes nouvelles. La vaccination est aussi rapide que prévu, sinon plus. Les États-Unis et d'autres économies se sont vite redressées après leur réouverture. Une forte reprise, stimulée par la consommation, s'annonce donc au Canada, suivant le levé des mesures sanitaires. The risks to the inflation outlook identified in the April MPR on both the upside and downside remain relevant. These include the possibility of more infectious new variants, of stronger household spending in Canada and stronger growth in the United States, the potential for weaker exports because of a stronger Canadian dollar, stronger potential output, which I've been discussing earlier in my speech, and finally, the potential for more persistent cost pressures to drive up inflation. So let me come back to one issue on which Governing Council discussed in particular in the lead to yesterday's decision, inflation. This shouldn't be a surprise since our job is to deliver low and stable inflation. As I already mentioned, inflation in April came in above 3%, and we expect it to stay around 3% over the next several months before moderating. While inflation over this period is likely to be higher than we projected in the April MPR, the underlying story is the same. Most of the run-up in inflation is simply arithmetic, the base year effects I've already talked about. Gasoline prices in particular are much higher this year than they were last year, partly because they had fallen so much a year earlier, but also because global oil prices have been rising in recent months. Indeed, commodity prices more generally have rebounded through the first half of this year in response to prospects for stronger demand as the global economy recovers. But these base year effects are by definition transitory. They will not persist beyond the next few months. What will persist longer until we see a complete recovery is the underlying slack in the economy. This slack will continue to put downward pressure on inflation even as the base year effects are fading. I mentioned the risk of more persistent cost pressures that we identified in the April MPR. Some of these could come from higher prices for raw materials that businesses use to make their products. Some of these pressures could also come from supply chain bottlenecks as the economy reopens and demand temporarily exceeds supply. Indeed, we have seen supply chain issues globally in products such as semiconductors and in countries such as the United States, where businesses have had more difficulty rehiring workers. These supply chain bottlenecks will likely become unblocked as things normalize, but it is a risk that we will be monitoring closely. All of this brings me to yesterday's policy decision. The Governing Council judges that there remains considerable excess capacity in the Canadian economy and that the recovery continues to require extraordinary monetary policy support. We reaffirmed our commitment to hold the policy interest rate at the effective lower bound until economic slack is absorbed so that the 2% inflation target is sustainably achieved. Based on our April projection, we expect this to happen sometime in the second half of 2022. We also reaffirmed that we are continuing our quantitative easing program to reinforce this commitment and to keep interest rates low across the yield curve. In that context, we maintained our pace of weekly purchases of Government of Canada bonds at a target of $3 billion. Decisions regarding adjustments to the pace of net purchases will be guided by the Governing Council's ongoing assessment of the strength and durability of the recovery. As Governor Macklem said in April, if the recovery evolves in line with or stronger than in our latest projection, then the economy won't need as much QE stimulus over time. Given the reopenings happening in many parts of Canada, we expect to learn more over the coming weeks to further inform that assessment. Nos décisions futures sur les achats nets vont dépendre de notre évaluation continue pour déterminer si la reprise est robuste et durable. Le gouverneur Macklem a dit en avril que si l'économie se redresse au moins comme dans notre dernière projection, il ne faudra pas autant de détente monétaire au fil du temps. Avec toutes les réouvertures au pays, on devrait pouvoir renforcer notre évaluation dans les prochaines semaines. We will have an updated outlook in July, where we will take into account all data and developments that will accumulate over the coming several weeks. Canadians can count on us to provide the appropriate degree of monetary policy stimulus to support the recovery and achieve the inflation objective. Thank you. Now I'd be happy to answer your questions.
Thank you, Mr. Deputy Governor Tim Lane. My name is Laurent Meunier, calling in from Vancouver, and we've got a question from the chat talking about lower interest rates. So are lower interest rates the only reason for the real estate frenzy in Canada? And where do you see these interest rates going in the coming weeks or months?
Well, as I mentioned in the speech, there are really two main drivers of the very hot real estate market, and one of them is just the fact that there's been a change in households' behavior that's taken place, and part of it is people are stuck in their four walls and they're just demanding more space, and also they can't spend money on other things they might normally be spending money on. They can't go out to restaurants, they can't go on holidays, and they don't care about wearing clothes because nobody's going to see them, so they basically they have money that in many cases they're using to try and shop for a better house. And of course, in the short run, the stock of houses is fixed. So when you have this surge of demand for more space meeting a fixed supply of housing, that pushes house prices up. Now, the other thing, of course, is interest rates are very low, and that's enabled households to finance larger, more expensive houses than they previously had been able to do, and that certainly is an important contributing factor. Now, at this point, of course, the need for low interest rates is really driven by the economic needs of the whole of Canada. We're not targeting that to the real estate market, but instead we're recognizing the fact that, we've still got 500,000 fewer people in employment than was the case before the pandemic hit, and we still have to keep conditions favorable so that the economy will grow its way out of this hole, and those jobs will come back, and that's basically what's driving our interest rate decision. But as I said, over time we expect the economy will recover, and then we will be in a position to start withdrawing some of that monetary policy stimulus, and that will, of course, be a factor when it happens that will contribute to rebalancing things.
Thank you. We've got another one here, again from the chat, talking about economic and labor force impacts.
Okay.
What would be the economic and labor force impact of businesses bringing employees back to work in person? And many businesses have recently announced that they're not going to be allowing employees to work at home as much in the post-pandemic time.
Well, we're all, I mean, it's been a very unusual time. And I think the last, as I said at the outset, it's been extraordinary the last 15 months, how many of us have adapted to working at home and found that we can still work quite productively. But I think every employer is sort of making a different decision about this and trying to decide what actually works best for the organization. There's certainly some benefits to having workers having the flexibility of being able to work from home to sort of balance their family commitments with their work commitments and avoid the commute that many people suffer through every day. And on the other hand, of course, there are some benefits to people being congregated. People often feel more productive when they've got colleagues around. They can interact informally. They can collaborate on work and that sort of thing. And so I think what remains to be seen is, two things. One is where most companies end up. I think a lot of companies are going to, and that also includes public sector government, and we're doing much the same thinking ourselves. Trying to sort out what's actually going to work the best and how much flexibility is desirable. But then, of course, depending on how many people do end up working from home on a more permanent basis, or how much that's sort of full-time versus part-time, you could have changes in the, you could have important changes affecting the economy. For example, businesses might find they don't need as much office space. Households might want to have bigger houses so they have room for a home office, and so those sorts of changes and the effects on people's need for cars to commute with, the need for public transit. So there are pretty wide-ranging changes that depend on those changes. And I have to say, we haven't got a complete scenario of how this would play out, but just to say that it's going to be a very important driver of the Canadian economy and the world economy going forward. You're on mute.
Somebody had to do it. Here we've got another question. This one's more specific, and it's actually from a client of one of our advisors here in Vancouver. So says, I'm currently renovating my house. And so from the time that I drew up the plans to now when the hammers are hitting the nails, the price of wood has tripled. My electrician has actually just doubled the quote for raw materials, and anything made out of metal is up at least 50% and has a 6 to 8 month wait time on delivery. So from what I see, gas prices are up, food prices are up, everything that I see and do is up, but the Bank of Canada says that they're working at reaching an inflation target. So how is there such a large disconnect between what us consumers see and what the bank is saying about inflation? And how can you square that circle for a layman?
Well, when we look at inflation, it's measured by the Consumer Price Index, which is put together by Statistics Canada, and that includes all the prices of all the things you mentioned. Not the inputs, but it includes the final price to the consumer, the fact that a new house costs more, and that's built into their measure of the cost of housing. But although there are some other there are some other complications to how that's incorporated. It's not the cost of buying a house, but the ongoing cost of living in a house. But it's basically those things all are factors. But certainly the overall increase in the Consumer Price Index is still. It's a little bit more than 3%, and it is pushed up by a number of temporary factors, as I mentioned. We're also, of course, looking at the the possibility of some of these cost pressures in raw materials and things like that feeding through into inflation more than we have seen so far and more than we are currently expecting. And that's something that we are, of course, keeping a close eye on. But so far, based on what we've seen in the data coming in, our assessment is that this recent rise in inflation is temporary, and that we should see inflation coming back down to its target of 2%. Over the course of the next year or so, and that's basically coming out of a period where inflation was closer to 1% during the pandemic. So we're really, of course, we've got variations in 1 year of very low inflation, 1 year of higher inflation, but we expect that when we come out of this episode, that inflation should be converging to its 2% target. You're on mute again.
Again, here's another one from the chat. What is the bank's view on the impact of the future economy of the nation's massive debt load? So how does Canada federally and provincially reduce that debt? And is this something that we're trying to do?
Well, I guess the first thing to remember here is that this has been an extraordinary period where there's been really an unprecedented economic contraction, and where it's been essential to tide the economy through. I mean, the economy is, to a certain extent, been on life support, has been needing a massive infusion of money from the government. Government's been in a position to borrow and provide money to households to support their incomes through this period, despite the fact that so many jobs were lost, and also to keep businesses from failing during this period. So there's been a lot of support to businesses, which has meant that they'll sort of live to fight another day. Basically that that they've been able to survive and should be in a position to reopen when the restrictions connected with the pandemic are lifted. And so that's really the source of this increase in debt. Now, of course, what we have to look for is where we land when we come out of this episode, and it's important for the debt to be sustainable, and that, of course, depends on the rate of growth of the economy being sufficiently rapid to that the debt is not actually increasing over time as a share of the size of the economy. Now, at this point, that means that many of these measures that were taken during the pandemic have to be viewed as temporary, and they obviously are expected to come off, and that should move us into a position where the debt dynamics are sustainable. Now, the more specifics around how to do that, and the current budget, of course, is not really the Bank of Canada's responsibility, but certainly that's the basic story which underlies the debt situation. And that's something that we're, of course, treat as the broader context in which we're making decisions on monetary policy.
Actually, this next question here from the chat, again, segues right off that last point that you were making about the consumer-led recovery, and that you mentioned a couple times in your speech here. So you referenced the consumer-led recovery a couple times in your speech, but many small and medium-sized businesses have been decimated by pandemic policy decisions. So is a consumer-led recovery in light of this likely permanent damage? Is that a reasonable assumption when consumers that are affected by these policies may not have a business or a job to go back to? And then what's the bank's view on what policy decisions are needed for a sustained recovery with real growth in the economy?
Well, certainly these have been tough times for businesses and for consumers. But the good news is that because of the volume of support that's been provided, and the fact that the credit has also kept flowing to businesses, the number of actual closures of businesses has actually been below the level that normally takes place. I mean, many businesses have been able to continue, and so although any recession it does have its scars. You know, any recession results in businesses failing and new businesses having to take their place, which can take longer. Then this recession seems to be one where those scarring effects have been reduced substantially by the level of government support, as well as by the digital technologies that I was talking about. The sense that a lot of businesses have found ways of still continuing to do business, and just thinking of many restaurants that seem to have been able to do quite a booming business off of delivery services, and in many cases, you know, have actually been doing reasonably well. Now, obviously, what remains to be seen is sort of how this evolves as the economy reopens. But certainly, the intent, as we hear it, is that these support measures will basically phase out as the economy is in a position that the support's no longer needed. And so, as consumers are coming back on, and as the restrictions are lifted, so we can go out and shop and go on trips and go to restaurants and all that, then the businesses will be able to reopen and become profitable again. So that's certainly the hope as we get out of this period.
Here's another one from the chat. Thank you so much. Again, on a similar topic, we see that inflation is rising, and at some point in the future, this may require raising interest rates. Is there concern in raising interest rates while Canadians are so heavily indebted with such large mortgages?
Well, this is an issue that we actually thought about last time we raised interest rates, which was starting in 2017. And then, you know, basically the issue was very much the same, that Canadian households are very heavily indebted. And so the implication of that is that raising interest rates actually has a larger negative effect on households, how much money households have left over after they pay their mortgage to spend on other things, and so it has a more negative effect on on economic activity than it does when households are less heavily indebted. Now, that's something that, of course, we would have to take into account when we're gauging what's the appropriate pace and timing of raising interest rates. I mean, as you said, I mean, certainly there will come a time when interest rates will be higher than they are now, but the question of when it's appropriate to start to move and how quickly will also take into account the fact that we're working with a different economy than we had even 2 or 3 years ago, and so we have to factor that into our decisions.
All right, and then expanding on this point, thank you to whoever put this one in the chat. The Bank of Canada traditionally increases the bank rate by 25 basis points at a time. Relative to the current rate, this would be a 100% increase and could potentially create a negative impact. Have you guys looked at using a 10 basis point move instead of a 25 basis point move?
I have to say that hasn't been a hot topic. I think the 25 basis points is kind of a convention. It's something that we've done for a long time now, and it seems to be well understood by most people. And generally, there hasn't been a sense. Certainly, when last time we raised interest rates from its current level was back in 2010. Because we had lowered interest rates down to 25 basis points during the Canadian recession associated with the global financial crisis. And, at that time, we raised interest rates from 25 to 50, then to 75, and so on. And that seemed to proceed pretty smoothly at the time. So obviously, we're going to have to watch as we move forward when the time comes to make sure that we're gauging the impact correctly. But that's something that we haven't really been focusing on.
All right, I want to thank you very much for your time. This last question is going to be the last question, and again, this one comes from the public chat where we had over 600 people registered. So charts and statistics are telling us that over 25% of the currency that exists today worldwide was printed in the last 12 months. Does this affect our future monetary policy?
I don't think that that can be right. Not specifically referring to currency. I mean, we've had, I mean, in Canada, we've, actually, if you think of currency printed, I mean, that's actually banknotes. And we have seen some increase in banknotes, mostly because a lot of people want some cash to carry around, but they haven't been spending it as quickly because they've been often using contactless methods of payment, contactless methods of payment rather than using cash to make payments. So there has been a slight increase in banknotes in circulation, but it hasn't been out of the ordinary given that change in how people pay for things. So certainly in Canada, there hasn't been anything like the explosion of actual printing of money that you're referring to. So that's and that's certainly not also the case in other major economies.
All right, thank you. I'm actually being told that we have time for one more. So this one actually is right up your alley as in terms of specialization. But where does the bank see the future of cryptocurrency going? It's, I think, past the point of telling people that they shouldn't do it, and it's one of those things that is reality now. Where do you guys see it going?
Well, as we've said before, we see this current wave of cryptocurrencies, Bitcoin, Dogecoin, and all those other products as largely a speculative product right now. I mean, there are obviously a certain number of true believers who think that these will be the money of the future, but then clearly most people who are buying these things are doing it because they think they can make a quick buck. And for a while they did, but I wouldn't like to talk to somebody who bought Bitcoin a month ago. I think I mean, these things clearly have had a roller coaster, and largely because the supply is limited and the demand is really driven by people's belief that that these things could be something they can make money on. So and these same price movements actually make it impossible that these things could become the money of the future in the sense of being used to pay for things on a routine basis, because basically, I mean, you're not going to accept your wages and something that could drop in value by 10 or 50% in the next week or so. So most people are going to insist on something that's more stable. So that's basically our view of the cryptocurrencies. But at the same time, we do have I think that it is important to recognize the fact that there is a lot of innovation going on in this space, and even if the current incarnation of these things is not useful for paying for stuff, then it still is actually leading to an exploration of technologies which may turn out to be very useful for some other purposes, and certainly it's very important to make sure that we can encourage the development of technologies that may actually subsequently be beneficial in either in the financial system or elsewhere. And so we're certainly very receptive to innovation in this area.
All right, thank you so much. That was our last question. And then I'm going to now pass it from Vancouver all the way to Winnipeg, where we've got Melissa Harrell with our closing remarks.
Thank you. I just really wanted to take the opportunity to say thank you very much, Deputy Governor Tim Lane. As a community of financial advisors and industry professionals, it's tremendously valuable to us to have the opportunity to hear from and speak directly to appointed officials such as yourself. So on behalf of Advocates National, our local chapters, and our membership, please accept our gratitude. For the audience, this presentation will be available on the Bank of Canada YouTube channel and the Advocates website, should you like to access the presentation in the future. And again, we just like to thank everyone for joining and for your time, and we wish everyone a safe and healthy rest of the week.
Thank you very much.
Thank you.
Thanks a lot, guys.
you.